Welcome, everyone. We're so excited to have you here for our high-impact webinar and fireside chat from Burn to Bridge, Symend's capital stack strategy. My name is Adi Batson from the Boast team, and today's session, we're hoping to have a really impactful moment where we can discuss some of the key capital strategy stack pieces that Symend team has put together. Whether you are a Series A co-founder and or at your third level of a round, here in today's call, we can basically walk you through some of the best practices for acquiring capital, but most importantly, think about the variety of non-dilutive resources and funding opportunities that are available to you. For today's agenda, we're basically walking through a quick introduction of our lovely hostesses, and most importantly, thinking about the various challenges within our capital stack market currently. From there, we'll take some time to walk over Symend's capital strategy, and most importantly, at the very end, we'll leave some time for all of our audience members to provide questions for specific references and feedback points. And if you stick along to the very end, we're likely to have a special surprise for each and everyone on our call today. Without further ado, I'd like to take some time to, of course, introduce ourselves to our lovely hostesses and speakers, Aly Khan Musani, CFO and COO of Symend, and of course, from our team here at Boast, Anastasia Hambali, our active moderator. But to kick it off, Aly, thank you so much for joining today. You have been with Symend for several years and basically been managing all of the critical points within their overall engagement for deriving great capital. But Aly, for our audience members today, could you maybe walk us through a little bit of what Symend does, your role, and how you've been able to find some initial successes growing your capital stack?
Sure. Thanks, Adi. Symend currently is the leader in intelligent collections, designed to help enterprises maximize the delinquency management and optimize key metrics. We look at things like recovery rates, liquidation rates, roll rates, time to cure, and we use behavioral science, and we leverage that with AI and Symend's digital debt recovery solution to empower businesses, including telecommunications, utilities, financial service firms such as banks, to provide personalized engagement to their customers and deliver positive financial outcomes for our clients and their customers. We were founded in 2016, and since then we have served over 200 million customers worldwide, driving meaningful and I think sustainable improvements in how those organizations view the collections journeys of their customers. My role at Symend, I started as the CFO. I opened the bank account here, which was back in 2016, so really, really early, and did the contract CFO role for 2 years, and then joined full-time in kind of September of 2019. And I've been here ever since, and more recently, the scope of my role has expanded to include our professional services teams, so our behavioral scientists, data and analytics solutions architects, and then also product and technology. So all the traditional CFO type roles like legal, IT, security, accounting, et cetera. But then these other pieces that are on top. So that gave me a little bit more of the operating title.
Wow, Aly, that's a lot of hats, very functional, but thank you so much for that general solid introduction. Moving right into our speaking engagement. Anastasia, thank you for being here on today's call. You are from our team here at Boast, and as our head of partnerships, can you maybe walk us through what Boast does, how we support other businesses who are growing, and most importantly, what do you think are the top points that you want to reference when we're thinking about non-dilutive capital and, of course, your larger capital stack?
100%. Thank you so much for that, Adi. Hello, everybody. Welcome. If you're not familiar with Boast, essentially what we do is we automate the process of claiming R&D tax credits. That means kind of like anything from SR&ED, IDMTC, CDAE, or IDMTC, as well as R&D credits in the US. So Boast can help you on both sides of the border. So throughout this entire session, if you have any questions specifically to the application of tax credits, just put them in a chat. One of my team members will be happy to help you and answer live. But for the purpose of today's session, and of course, like why we have Aly here, is because we wanted to talk about how you can layer non-dilutive capital on top of your equity raise so that you can be more resilient. And just for context, to date, Boast has helped companies claim over $650 million US in tax credits to provide them with better cash flow. And in case you don't already notice from the title, I do want to highlight that tax credits and grants and some other options is actually really underused when it comes to capital strategy. With that in mind, Addie, I think I have a visual that I do want to share with the group. Perfect. This is exactly what I was talking about. Some of you might be familiar with this, but essentially, these are different capital options, whether dilutive, non-dilutive, from the early stages to kind of like scale and profitability. And I do want to emphasize what a treat it is to have Aly here with us, because it is not often you find someone who gets in at the ground floor and all the way kind of like to scaling it up. So I'm really excited to dig deeper. But to give you a bit of a kind of like highlight reels before we dive deeper, first and foremost, kind of like at the top right corner, you'll see revenue-based lending, venture debt, and banks. These are, generally speaking, the first pillar of non-dilutive credit. This is the debt portion. Understandably, in order to secure that, you need a little bit more revenue, a little bit more credibility before you can get a check from this debt lender. So what are your other options if you're not particularly in the later stages? There are two other pillars. The second one is grants. So these are essentially anything that the government of Canada and some government in the US actually provide companies with. It can be for hiring, it can be for market expansion, the whole gamut. Again, if you have any specific questions, put them in the chat. My team will be able to help, or we can follow up with you after. And last but not least is the tax credit portion. This is severely underused. Why? Because this is money that you are entitled to. It's just that not a lot of companies actually follow up and claim that back. And then we're going to talk about how Symend use tax credits and grants and debt and also combine that with their equity to fuel their growth. With that, I think we have another visual for our audience here today. Aly, would you mind walking us through the capital strategy that you have from the earlier on to where we are right now?
So I think that obviously Symend was founded in a bit of a different time than where we are today. We're 7-8 years into our journey. And so at that point in time, the way we thought about capital was with a lens and a view towards the business. So what did we need to actually fund our anticipated growth? And how did we think about the capital raise in terms of making sure that we gave ourselves enough runway so that we could recover from any of the unanticipated, unexpected delays, which always happen with early stage companies. And so none of those things should be a death blow to your company if you've planned your capital strategy out correctly. In the early days, it was really about putting the budget together and knowing that the clients that we were targeting were the largest of the large with very long buying cycles. And so you needed to understand that you were making a lot of investment upfront, significant investments where you needed to hire teams of people, you needed to onboard, and you needed to prove your value to those customers. And that would ultimately lead to stickier long-term contracts. That being the case, that requires cash upfront. And so we did raise quite a bit of money. And even in the early days, we needed more money to operate so that we could onboard those clients and have the appropriate amount of time to make sure we executed well and correctly and that nothing was rushed and that we didn't cut corners. From there, what we would do is take a view towards the level of investment we would need, i.e. what would we need to spend every month, and what large clients would we be targeting and how long would it take to land them. And we would build a profile of the company based on a targeted sort of net burn number, which was, hey, here's what we need to spend in terms of the headcount and hiring plan. And here's what we would expect as revenue. And then against that, we would fund the difference with our equity primarily. And with that, it ended up working out that, you would have to build in buffers along the way, et cetera, to make sure that you weren't very tight in terms of how you did that raise. And in Symend's case, we used 18 to 20 months of runway as a sort of a guidepost when we were looking at this. And as we started to fall above or below the range, that would be the indicator to the business whether we could accelerate our growth activities. So if we were coming in ahead of schedule on some of the things, we could accelerate our growth activities and make more investments in outbound marketing, outbound GTM motion. Or if we were falling behind, we would have to modulate our headcount accordingly. And some of those things are naturally complementary because you're not going to hire people for clients that haven't really arrived or aren't far enough along in the pipeline. And so some of that is a bit self-correcting, but you have to still make sure you're vigilant and diligent on top of the cost structure so that it doesn't get away from you. So I think sorry, go ahead.
All right. Just kind of want to dig a little bit deeper to that. So what you're describing to us, and my understanding is correctly that these are essentially the expense profile and growth profile that you're balancing kind of like throughout the entire operation cycle.
Yes, that's right.
Okay, gotcha. And then in terms of kind of like maintaining kind of like the whole 18 to 20 kind of like in mind, and then knowing the expense profile and growth profile, what were kind of like the turning point when you kind of like realize, okay, now that we hit like certain milestones, this is now time for us to raise for the next round, equity round?
So what ended up happening in those instances was the growth profile would pretty much dictate the round dynamics, which was if you're going to go international. So for example, the UK and in Brazil, where we've had some expansion opportunities and where we're currently operating, it takes a lot of time. It takes more time even to establish a business there. And it's quite expensive to operate in foreign jurisdictions. So you're going to need even more money. And so as you target those markets, you have to have a realistic lens about what it's going to cost and what milestones you're going to use to measure your progress. In that's how we would formulate our view of how much money we would need into the next round. On top of that, where we would, look at things like our grant funding, et cetera, that has been done in a very, I'll say, regimented basis over the past several years. Every year that I've been here, and Boast has been involved, of course, in the journey all the way through. And that piece of non-dilutive funding is actually critical because what that does is creates additional cash buffer. So even if you're wrong on your initial estimates and everything's delayed by, say, you had factored in 1 quarter of time with respect to revenue numbers and it ended up being 6 months or 9 months, the non-dilutive financing can make the difference between you having to go out early for more money or being able to hit your operating milestones and then go out in a stronger position with a better valuation when you ultimately do go out and raise.
No, that was really good. And I would love to circle back on that kind of specific strategy and break out which one is equity and then which one is debt, which one is non-dilutive, kind of a little bit later. But digging a little bit deeper into kind of especially your journey and layering debt specifically with equity, what were some of the things that founders need to keep in mind? Because one of the patterns that I'm noticing kind of in the ecosystem is there are some founders that are pitching debt lenders the same way as they would pitch a VC. So tell us a little bit more about the nuance there.
It's quite different. I'll say that. So the first thing to keep in mind is that the debt lender, their lens on the business is completely different from the VC. The VC has infinite exposure to the upside and the lender can only see downside. And so what they are looking at is a very different angle of the business, which is what can go wrong, not what can go right. And with that lens, your entire presentation needs to be defined differently than you otherwise would if you were trying to raise equity. They actually don't make any more money, even if you are horrendously successful. They still collect their same interest payment and the debt is still repaid at the end of the day. So really they have no special, incentive to the upside in your capital stack. And so the way that I look at it and the way that we've looked at it at Symend is when we were positioning for the debt specifically, the primary thing is that maybe a lot of what has been lost over time is that banks, and in terms of the primary senior lender, historically have never lended money or lent money to companies that are losing money. So that is a very that in and of itself is a very difficult thing. So the idea would be that, and they are doing it now, but with a view towards investing in those companies, they see a path to growth, they see a path to break even, and they see a path to profitability, and they want to be early. And so that has modified their approach. And so for that, I think what you'll find is those companies, as you're closer to break even, you have to show them a revenue profile and a profile that doesn't have a very large burn piece to it, which is likely going to scare off potential lenders, I'll say. So there's the right time to approach them. I would say that, if you are making big bets on the business right now and you're spending a bunch of money to get up to speed as Symend was in the early days, that wasn't necessarily the right time to approach the lender. I think the second key point to understand is that debt is not a primary funding vehicle for the operating expenses of the business. It's actually a cash security blanket. And what that is so in Symend's case, when we were in the middle of our last kind of B extension round, sort of towards the end of 2022, it took a bit longer to get the syndicate together and to get valuation aligned on and to get paperwork and documentation in place, which means it took longer to get the money in the bank. Well, you have two options at that point. Either you slow down the business so you don't spend as much money, you don't do the hiring, you basically put the brakes on things, or you tap the debt because you know that at the end of the day, it's just a bridge to the other side. And you have a journey, so you just have to cross the bridge. And so as long as you're confident and comfortable in the fact that the round is going to close, it's just a matter of time. But you want to make sure that you're not changing or pivoting the business because of knee-jerk reactions or on a dime, because it's very disruptive to the people who are trying to day-to-day be successful against client-related outcomes, et cetera, et cetera. They have to have a level of predictability so that they can do their jobs. And so my job is to make sure that liquidity isn't their issue. They don't need to think about that. We think about that so they can do their jobs. So it ends up being an enablement mechanism more so.
I like kind of like that perspective, like enablement mechanism. So with that in mind, how did you integrate kind of debt specifically into your cash flow kind of like planning without over leveraging? Like, is it like the X amount of debt by X months? Is that kind of like some sort of framework that you use?
So a lot of the banks have a standardized framework, which they will loan against. But I think the other thing that we didn't bring up in the first part of the conversation is it's a self-regulating mechanism. The debt piece in it has a covenant package associated with it, which at the senior lender level is meant to protect the bank, as it should. And so the thing you have to be aware of is as you draw it, your forecasting has to be fairly good if you're going to draw it, because you've got to make sure that you have enough liquidity such that you don't trip the liquidity covenant in the debt, because that is going to cause you a different problem with the bank. And so, there are, so I guess to answer your question more directly, the self-regulating mechanisms contained in the debt will likely keep you from making, mistakes. If you've got a reasonable forecast that you can rely on, you'll know if you're flying too close to the sun, for lack of a better word. Typically the debt is also split into two pieces, where you'll have a conventional term debt, which is debt that, you'll borrow, say, for example, a $5 million piece of debt, and you'll have to pay it back just like you do a mortgage. Every month it'll just come out of the bank account. Yeah. There's another piece which the bank will give you when you're a certain size, and it's called a revolver. And that revolver is usually interest only, and it can go up and down depending on the needs of the business. So you can tap it, you can pay it back, and then you can redraw it. A term debt is a one-way door. It just basically amortizes down to zero, and that usually takes anywhere between 48 and 60 months, depending on the institution.
In Symend's case, how did you evaluate which form of debt was the right form for that stage of growth?
That's a good question. So I think for us, we had very specific requirements going in, and we knew what we were going to use the debt for, i.e. we're not operating the business with this debt, and it is going to be a security blanket, and if we need it, we will use it in these specific instances. So I think the first thing you can do is internally get very clear amongst the management team about what this money will or will not be used for. Then I think the second thing is going out to a series of lenders and putting out more or less a bid document, which is what we did as an RFP. We specified a process. We specified dates for submission. We specified when the reviews would happen and when we would get back to them. And then we used a very prescriptive scoring system against all of the attributes that we valued in that facility. Everything from the interest rate to the term of the debt to the split between the revolver and the term debt. All of the things that you would want to look at when making your decision, but stack ranked in order of importance to Symend. And that's what the scoring system did. I think once you do that, it brings a level of clarity amongst a bunch of different options because it allows you to think about it with a consistent framework. And that is, there are a lot of different variables between what different banks will pitch to you. But this sort of equalizes and levels the playing field. I think the last thing that's important to note is that there is very much a relationship component, a trust component to the banking relationship that you're going to form. It's really not a transactional endeavor. So as much as the scoring system and all of that I'm telling you about comes into play in making the decision, there is a qualitative aspect that needs to be, it should not be discounted. And that is that you should go out into the market and find out when you're going to partner with a financial institution, how do things go when it's not all going well? And when there are bumps in the road, because these are long-term partnerships. They are not, you're not just going to go and switch banks tomorrow. And so that really needs the long-term view of it, how you're going to operate in the ups and downs of this is an important consideration.
3 things that I love kind of from what you just shared with us. The first one was that self-awareness and self-evaluation first and foremost to understand what is important to Symend and how you want to approach it. I think kind of like right now, what I'm seeing is there is more and more appetite from founders, especially in the earlier stages, to work with fractional CFOs, maybe kind of at the beginning, just to understand kind of like that piece. So that is great because without that, you wouldn't be able to go into like the next step or like the other 2 things that I love, which is 2, you put that as an RFP. You let them kind of like come to you. And then the third piece is that you're scoring them in the same way. So you're making decisions kind of like on this partnership, as you mentioned, kind of like is good because it is a long-term partnership in a way that is both pragmatic, but also kind of like evaluating, again, like you said, the relationship piece. So absolutely love that approach. I want to circle back to what you were saying kind of like about some of the terms and especially on the covenants. What are some of the things that you would want founders to know or watch more closely when they're evaluating kind of like a potential debt lender?
So I think that there is a tendency to get fixated on a headline number. And the headline number is, oh, look at the size of the debt. So similar to the way that people raised money in the round size or what have you. But the reality is it's not actually about the headline number. It's about the accessibility of the number. And so typically as you dig under the hood of this, and some of these structures, like I would especially advise founders to get, contract CFO or proper financial help involved because there are some tricky provisions in these things and you need to understand them. And it's really about unpacking them and making sure that you understand the impact and the implications if you're going to go down a certain way. And by that, I mean, someone can say to you, hey, here's a $15 million debt facility. But the reality is when you look at it, it may have certain threshold limitations like, hey, that's the maximum of the facility, but we're going to loan you 6 times your MRR. Well, if you have low MRR, if you have $1 million a month in run rate revenue, you're going to be able to access 6 of the 15. It doesn't matter what the piece of paper says. So that's just one example of, it's not a bait and switch by any means from the bank. I think it's very genuine. What the bank's doing is they're saying you don't have to come back to us. Even when you grow, there's more facility available. It's all self-contained. But we are putting in stage gates so that you don't get out over your skis and draw more than you should based on your size. So it is a self-protection mechanism, but you need to understand it. So if you have something that's 15, but it has a different cap and a different accessibility or availability, you need to understand that versus something that's 12 or 10, but will be more accessible to you in terms of the draw. So that's the first thing. I think the second thing is, as you mentioned on the covenant piece, typically when you're trying to establish what that looks like, modeling comes in. It's very important because typically those covenants are cash over debt. So you need to have 1.35, so 35% more cash than you do debt. 1.35 to 1 is the ratio. And so that is effectively your buffer. And some of this ends up being self-correcting. Like if you have term debt, they're taking it out of your account every month. So the entire ratio is moving down in proportion, right? So the debt's moving down, your cash is moving down on a one-for-one basis. So it's, again, self-protecting. But you have to be more careful when it's a revolver, because if you draw it, there is no requirement for you to draw it back. And so there is this sort of human tendency that is around things like credit cards and whatnot. It's like, well, I'll take care of it next month and next month and so on. And it ends up being a building problem. So I would strongly advise against that. It's a proactive thing, and make sure you know what you're getting yourself into at the front end.
No, that's really good to know. And if you have any questions specifically on that, please drop them in the chat, because we can go in so many different directions when it comes to that and the options and the providers and the form that it comes in. So let me make sure that I'm asking the questions that you actually want to know. In the meantime, I do want to kind of like switch gears slightly into the different pillars of non-dilutive capital, which is on the tax credit side and the grant side. My understanding is Symend has been layering them since a very, very early stage, from SR&ED, IRAP, and DS4Y and other programs. So we'll dive into that, but kind of like to do a quick level set for those of you who are not familiar. SR&ED is essentially a government program. So it is spelled SR&ED. So essentially what happens is anything that you put into research and development or product development, essentially it is a way for you to recoup that investment from the government at the end of the year. So any questions about that program specifically or any tax credit programs, again, also drop them in the chat. We have my team member Matt R on standby answering any questions specifically around that. But in Symend's case specifically, I think you kind of in the earlier days, you started with IRAP and then started tacking on the other programs. Can you tell us a little bit more about that?
Sure. I say that IRAP was very handy in the early days, because if you could define the scope of the project specifically, you can get dollar for dollar funding against labor that is specific against those projects. And so it's an important cash flow consideration, because once you're in the program and you're sort of receiving a monthly amount from the government against the project, and then you're submitting project milestone reports and visiting with your representative, once a month or once a quarter, depending on your cadence, you can get access to that funding right away. I think the other thing to understand is that with SR&ED, it is the scientific research and experimental development tax credit is an annual thing. So you're actually submitting it with your tax return. And so from the time that you actually incur the first expense, say that's a January expense, it may take you until June of the following year to file your tax return. And it may be several months after that before you actually get the money. And so it's important when you're thinking about the programs, there is SR&ED is a very valuable thing to us, make no mistake about it. And we access it, and we have accessed it regularly. But we are we're very realistic about what it's available for and what it can do for us and over what time period. And so, if there's any kind of guidance here, it's that you should not be overly optimistic about how that grant will actually fund itself into your bank account. And if you're counting on it to provide you with a certain amount of liquidity by a certain date, that is not the right answer, in my opinion, because things do happen to those submissions. They're delayed. They can be flagged, held up for audit, which means they take even longer. All kinds of things can happen to that. So I think that when that does come in, it ends up being a nice liquidity bonus that you're getting, but the timing is often uncertain.
No, that's a really good kind of like way of positioning something like tax rate program like Shred essentially as kind of an extra buffer in managing the cash flow. In terms of other government programs, you mentioned IRAP kind of like at the very beginning, essentially to help offset some of the product build. Are there any other government programs that Symend has stepped into?
Yes, there are a couple of more that we are, even in the process of now as we speak. One we've done regularly, which is the interns funding and grants for summer internships, which we have, my goodness, such a strong intern component contingent here, probably about anywhere between 15 and 17 at a given time. So fairly large contingent. But it's been an outstanding program for us. And a number of those interns have actually been offered then full-time positions at Symend. So we have multiples of them that are now working here post graduation, but they have 2 years or more with the company and they really understand it from the inside out. I think it's, to have an intern work on a large financial institution as a client is like a eye-opening experience for some of them as you're still in school and you get some great experience and we get some really good benefits in that we can bring people in early. They know the company and by the time they graduate, they're ready for the next challenge. So we have that one. And then there are recent programs with respect to Canadian government's adoption of AI programs, which I think is a brand new $100 million fund that we are just in the process of submitting some applications for.
No, amazing. I love kind of like when companies are intentionally thinking about their capital stack and how they can actually access different sources of non-dilutive funding. In a previous life, I used to run a revenue accelerator, so mainly working with companies that are $1 million plus in annual revenues, trying to get them to 10. And then a number of times, I sat down with a founder and kind of like thinking about their cap table and their next raise and not realizing that they probably overextended kind of like earlier on and not kind of like thinking some of the implications kind of like down the road. So I love the intentional planning that Symend has done kind of like to do this. With that in mind, I also want to share like one tip like for all the founders out here, which I'm sure if you're in Canada, you have access to a lot of different non-equity based like accelerators or kind of like community groups. You have to find yourself your startup stack perks. Like, what does that mean? Any program administrators would give you access to things like AWS credits or GCP credit or Microsoft credits. These are the kind of things that you want to introduce earlier on, like to reduce your burn. And on top of that, more and more programs now actually include the operational tech stack. So anything from your accounting, maybe kind of like project management, could be kind of like payroll. So definitely like look into that. And if you missed it, Rippling actually just announced a startup perk program, which I believe gives you like 6 months pre-payroll. So definitely like look that up. And if I'm not mistaken, I think their team actually registered kind of like to be a part of this webinar. So if you're in the audience and you have that link, please share that with everybody so people can start reducing their burn. And going back kind of like to the central topic. So Symend is obviously at a very later stage. Like you guys are at a scale stage and kind of like growing. If you were to go back to kind of like a company that's probably making about 2 to 5 million ARR, what would be the general framework or advice that you give them in terms of selecting the mix of equity, debt, and credit, tax credit specifically?
So I think companies in that stage are built very differently today than they were in the world pre-ChatGPT or pre-AI, right? As a demarcation point for an evolution or a journey. And so the things that are happening now, I would say, are very interesting because there is a very lean cap table, minimal raises where companies are getting to profitability a lot earlier.
Wow.
So it's kind of changed the nature of the conversation, I'll say, in that I think the grant funding is there. It's always available. But like I mentioned, the vagaries of timing make it very difficult to put a line item into your cash flow. So you almost look at it as something that is a nice thing that happens every year. It's just that you don't know when it's going to happen. And so it's great that it drops in. You'll get it, but you need to make sure that you've buffered around it in case it's delayed or it comes through at an amount less than what you thought. Um, with respect to debt, I think that is more accessible at the earlier stages now than it was previously, because typically those companies, in order to get from 2 to 5 to 10 to 25, had to burn a lot more money, in the pre-AI time in order just to ramp up revenue. And so now you could be a lot closer to break even. You can accelerate a bit, but not really be in this sort of burn profile that raises eyebrows at a bank. And so I think that is actually a very attractive way to go if you see something that's working and you're like, hey, I can stay pretty close to break even, or I am profitable in that regard. Debt is an ideal instrument if applied judiciously with the right kind of finance person on top, who you need somebody who can say no a lot. And then, equity, of course, would be the primary driver. Key things you would look at would be benchmarking things like, it's actually a big thing now, and it has been for a while, but the way it's accelerated is ARR per FTE is a big thing, I think. And as you're starting to look at that, considering, agents or an AI related component to your business as part of the team, companies have been able to really scale from what would have been previously deemed almost impossible to where they're getting to now with a very, very small team.
Mm-hmm. Ali, thank you for that. I think kind of like in terms of what you just shared with us, especially with the AI kind of like being the line of demarcation, we're also seeing that some companies now choose to raise one institutional round, typically kind of like a seed round, and then almost like bootstrapping or kind of like using their own revenue, maybe like with the eighth of like debt as they scale. Do you see kind of like the same things right now, like among like your finance peers? Like, is that like a trend that's happening?
Very much so. I would say that I think people understand a couple of different aspects of what you're talking about in terms of the way that the market is moving. One is that equity is very expensive because it's high risk. And so people that are taking that bet are going to want, a chunk of the company. And so if you think down the implications of that, it becomes kind of apparent that, well, I have to give up a level of control. So how much of it are you willing to give up, and what are the terms and conditions of that? And you're bringing somebody new into the business, and all of the things that are associated with that, right? Which can be good depending on what you're getting from that relationship and that partnership.
Yeah.
But it is obviously, like it's always been, and it's very expensive in terms of what you're giving up. And then I think the other thing is that people are thinking about those businesses differently now. They're not thinking about them the same way, which is, you know, raise a bunch of money, scale to a revenue number, and sell. The mindset difference is actually quite stark, and how you manage the business is quite stark in those particular
Mhm.
differences. The difference is now, if I'm building something from scratch, I might be viewing that as a cash flow business for myself. Like, I actually don't plan to ever sell it. I just plan to grow it. I'm going to get a little bit bigger every year, or a lot bigger every year. And I know how to do it. I want to do this thing. And it's going to create an income stream for me and my family to live the life we want to live. And so that's um, it's a completely different view of the business and how you manage that business versus the one I mentioned previously.
That's really good to know. And if I do kind of a quick a summary of kind of what we've talked about, essentially, equity specifically as a capital option is something kind of like that you use to fund long-term bets and then build leverage kind of like as a whole. Whereas debt, like once you have like proven product market fit and a healthy go-to-market engine, that's when you start tapping into it. While looking at the other two pillars, which is like tax credits and grants, while underused, that should be introduced early as part of kind of like the capital mix, so that it's like a continuous buffer layer as kind of like the company scale. Those are essentially kind of like the three, like at the very high level, general use of the different like capital stack. Did I miss anything there, Ali?
No, I think the only nuance is on the debt. If you're break even or you're in the plus, then yes, debt is something you can use to actively manage how you run your business and where you fill kind of liquidity gaps in your business, et cetera. If you have a burn profile that is, significant expense over revenue, that's not something you would want to use because the risks of something going wrong in that situation where a customer churns on you or the revenue doesn't come in as planned can get you in not a good place with respect to that debt. So then it becomes more of the safety blanket, which is what we talked about earlier, the bridge to the equity round, et cetera, et cetera.
Mm-hmm. So let me ask you this then. For someone that is not a financial expert like me, so let's say kind of like I'm a founder of a company, and then for a Series A, I would like to raise $10 million. I know I would need like $10 million in order to get to the next milestone. With that in mind, how would you approach kind of like that need for $10 million in capital? Like, what would you suggest as, oh, this will be equity, this will be debt, this would be like any other extras, like as different capital options?
So, how would I start that conversation?
Yeah.
I would likely say, I don't believe you. You probably don't need 10. And then, it would be starting from like, how about I give you 0 and then let's work up from there. And then we figure out what the real number is, right? Like maybe it's 8. And then we go
That is the no that we're talking about, everybody. That's the
totally what
no
it
from
is.
your
It's
head of
totally what it
finance.
is. It's totally what it is. Um, that's just now it's just ingrained in my DNA. It's like, I don't believe you. So you have to start somewhere. I think, you build up to a number, and if that's 8 or 9, or even if it is 10, you look at the foundational pillars of what that's built on. So the expense side is like a virtual certainty. Like if you hire somebody, that you have to pay them next month, and that's coming out of the bank. The uncertain part is how's the revenue going to come in? What's the profile of that? And so you really have to have a good visibility into your pipeline, and how much of it are you discounting and by what, and how much of it is late stage, and how much of it is going to drop by when. What's your level of certainty against those things? Once you can profile that out a bit, you get a sense for like what you need, and you should, buffer it up to be fair. Um, I think if you're sitting there and saying, okay, well, that amount of money, and if it's 10, I want to do 10 or 20% above that to make sure that I can take into account any of the unanticipated delays, things happening, or I churn a customer, something happens, right? Pandemic falls out of the sky, and who knows? You have to be able to withstand those things for the longer term. And behind that, what you would do then is, if you've got the money, you likely can get a debt facility that's, a couple of $1 million or $4 million or something like that, depending on, again, the revenue profile and some other things that are contained within your business, which is how close will you be to break even by the time you hit your milestone objectives, which is what you raised the $10 million amount on. So when you get to the end of the other side of that journey, what will the burn profile look like of that company? Expenses minus revenue. How much will you be light? And how much runway will you have at that point in time? That's an important instructive mechanism to determine, well, what happens next? I'm going to raise again, but now my valuation will be X. And I do have sort of this $5 million sort of debt facility. And the idea would be to say, I'm pretty sure about the valuation that I want, and that there'll be some negotiating. And I need to so somebody will be interested, and I'll need to create some room in case I want to hold my ground on that valuation, right? Because I'm going to be burning a little bit. And so maybe I'll tap the debt at that point to give me some additional liquidity, which allows me to have negotiating leverage. And I'm negotiating from a position of strength with somebody that I know wants to put money into the business, but is maybe hoping that if they wait me out a few months, that, maybe I'll move a bit on my valuation. This way you anchor and you say, well, no, I've drawn my debt. I can be here all day. How long do you have? That kind of thing.
No, that's really, really good tips. I'm gonna start kind of like reading some questions now from the audience. I think the first one, this is kind of like quite timely, I think, for a lot of founders out there. Ali, in your experience, especially kind of like at the growth stage or like later stage, what are some of the nuances in pitching to US investors versus Canadian investors?
It's an interesting question. So we did our first round, which was a $10 million Canadian round, which was a Series A, was actually a US firm, which was Ignition out of Seattle. But the leads on the subsequent rounds have all been Canadian, and it was Innovia primarily that has funded all of the subsequent rounds post that. And so the majority of the money has been raised in Canada. I would say the Canadian venture ecosystem, Innovia, is one of the biggest, has some of the biggest funds, and are invested in some of the most known entities in Canada. So I don't really see a difference in terms of how you're pitching to them. I think it's more about the fund and the fund style. And
Mhm.
so, I think you just have to know who you're targeting and why. So there are companies that are you know, later stage VCs that will invest in B and C rounds. But you're too early for them at A, because the size of the check that they want to write is very large, and an A company doesn't need that. And also the growth profile is different, the risk profile is different, et cetera. So it's more about finding the right investor for the stage that you're at as a company than it is about the geographic differentiation between
Right.
how they look at it.
I'm going to extend that question from our audience and then tap into what you were saying about finding the right fund, not just at the right stage, but kind of the right fund for you. To that extent, can you share a little bit more about what that means in terms of board governance, especially like at the later stage? Because typically in a later stage, they would receive a board seat, correct?
Yes. Well, even in the early stages, so even in your Series A, you'll likely give up a board seat there, because they will form the top of the pref stack at that point. So they will have preferred equity over top of all of the commons.
Mhm.
And so that's an important consideration when you give it up, but also they bring resources, expertise, et cetera. So you're getting something for that. And I think it's our board in particular has been invaluable, I would say, to me and to our management team and to our business, in terms of, you've got a group of individuals who have significant business expertise, have a significant Rolodex, can pull resources to the table when you need them, can give you insight and opinion that are grounded in a lot of experience,
Right.
and can pull situations and circumstances out that are mm, that have strong similarities to whatever you're facing. Now, the lessons may not track 100%, but you can take a lot away from those and use them to inform your view on how you should approach that situation. So, the other, the more direct answer to your question is, um, Innovia obviously has a board seat. Impression Ventures, Ignition, all of the early ones, and a few others, and we have a couple of independents as well. And so Symend, because it's later stage, we have audited statements. We do the
Yeah.
monthly filings. Like, we have I would say, a very mature financial process, because it's required. So I
Mm.
think you're touching on something. Whoever asked this question, I think you're touching on something that's a very good point, which is, y- you as a company really have to be ready. Um, there's a maturity level that comes with the business, with the organization, to take on the responsibility of that reporting obligation, and not just think that I get the money, but it doesn't come with anything, right?
Yeah.
There's a thing that is very much, it's not just about what you're going to do with that in terms of operating the business, but understand that the financial process and the finance part of your organization, it can't just be run with a bookkeeper or just out of your bank account, the way it was being done in maybe the early days, as it was a much scrappier type startup.
Yeah. That's really, really good tips. I am scrolling now to see some other questions here. The next one that we see is, how do you manage to keep enough runway while considering your scaling cost? So I think it goes back to kind of like some of the capital mix, but maybe something a bit more like how do you view this essentially as a framework to manage cash flow? So I'll repeat the question. How do you manage to keep enough runway while considering your scaling cost?
I mean, that's the thing we battle with every day. So I think that question hits the mark. There's a constant pull for resources within the business. Everybody wants to hire, for everything all the time, and so so every headcount goes through me. So that's how we manage the runway against the resource. Like the bank account is, it's airtight, and so the resource piece, we manage it from two ways in terms of how we manage runway versus the scaling attributes of the business. The first way we manage it is by making sure that we put a lot of thought and diligence into when people are asking for resources. And that can be anything from contract resources, outsource providers to, a new position or even a backfill. Every backfill in the company is not automatic. Just because someone leaves doesn't mean you get to replace that person. We actually go back and look at situationally, is that the right hire now for where the company was at today? Because they might have been in that role for 3 years and things have changed. And are we better off redeploying that headcount somewhere else? So there's a expense management side of it, which kind of keeps things in check. And then the other side of it is you have to be realistic about the scaling. So it can't be this hypothetical scaling, which is, no, let's pin it in a very real conversation about where the sales pipeline is at and where our GTM motion is. So don't tell me that something's going to close in 3 months, where if I stack out all the things I know about the sales side of the business, I don't think so. I think and I know that this is 9 months from now and we're not going to pre-hire for that thing and so on and so forth. So there's this like very intentional methodology that we use to sanity test all of the decisions.
Right. So that goes back kind of like what you were saying about being the definite no.
Yeah, I mean, there's no ambiguity around it. There's no ambiguity around who that definitive no is here, for sure.
For kind of like a little bit of context for the audience here, we've been working with Symend, kind of like Boast is their shred partner, kind of like for many, many years. When we also had the I had the pleasure of asking the Symend founder, like Hanif, about his experience actually hiring a CFO. And believe it or not, Ali, one of the first things he said to me was, expect a lot of no's. So it's like you guys are very much like aligned on that. The relationship has been established, so expect a lot of no's. Well, at the risk of sounding self-serving, I would love to ask you this one question because you've been with Boast kind of like partnering with Boast for a while now. As someone personally, many lifetimes ago, that has claimed tax credits, specifically shred, like in-house, so that means a lot of manual work. Can I ask you, what was the biggest pain points that Boast relief from you and your team when it comes to shred claim process?
We just don't have the time. And so it is a very intensive process to do it well, and people should not underestimate the amount of time that it is going to take to get something filed. I think that's one piece, but I think the second piece, there's a time aspect, but there's a quality aspect that should also not be underplayed. Because this thing where you think that you're just going to shuffle something together and throw it in and you're going to get, $500,000 or $1 million, it's going to suddenly drop into your bank account. Well, that's not the case. And I know that for a fact because the government looks very closely, very, very closely at each one of these submissions. And yes, Boast has been with us since the beginning. And so this is kind of a trusted partner. And I mean, you might have been able to tell from some of the commentary that we've had over the past little while. I don't take anything lightly and I dig in hard on every single thing, every single day, all the time. So nobody gets a pass for anything here. And so Boast doesn't either. So you have to hit a pretty high bar in my mind to have been with us for 6-7 years now. And I think that what that journey teaches us is pretty invaluable. The first thing is that it's actually not just about putting in the shred filing. It's about, well, what happens when it gets audited? And just on that point alone, we've been through 2 government audits with Boast in that time. And they are extensive. We get an individual who comes into the boardroom. We prepare our strategy up front. I sit down with Kyla, who's been with on our engagement since the beginning. And we talk about like, okay, where are they going to look? What are the key things that we need to be aware of? What are the sensitivities? How will we manage those? Do we have the right messaging, et cetera? And so I think when you're thinking about the provider, it's really not about who can just do the filing, but who's going to be there if it gets pulled and it gets pulled into audit. How much experience does that filer have? And where are they going to be? Like, is that, is somebody going to pick up the phone when that happens?
100%. Yeah, these are kind of like certainly like a lot of different things that we do for our clients. And then kind of like you point out to like the timepiece, this is why our technology is built kind of like the way it is, because you have someone like Carla who's like the expert, but you also have a lot of technology integrations to make kind of like the data and the evidence building piece like a lot easier. And it just kind of like for those who are not familiar, if you've ever claimed shred, you will get audited at some point, kind of. It's just kind of like regular kind of a government like cadence to actually like have like certain claims audited, but it is kind of like how you deal with that audit that will set you apart. Aly, I'm going to take the try to kind of like basically recap like some of the things that we've talked about other than the kind of default capital options. What I'm getting from you today is essentially when it comes to capital strategy, start early. It's not about kind of like, when I get to this point, I will start thinking about it. Like you have to start from the early days and you focus on the runway, it sounds like, from the way you and your team approach this, not so much like the round size, but really kind of like the liquidity that allows you to continue to grow. And last but not least, I believe kind of like what we hear from Aly is ultimately like the way they look at capital is a way to continue doing what they do best, which is serving their customers. The capital should be a tool to serve your mission, not necessarily to distract you from your mission. Did I miss anything there, Aly?
No, that's right. I think that those points are the key ones. I think runway is actually the key one, which is, just making sure that you have enough liquidity to manage the business through a bunch of turbulence, either within the business or external to the business.
Yes.
And you have to be able to get through both. And you also have to be able to understand that you can't see everything into the future. And we live in very turbulent times. So making sure that you have enough money in the bank so you can weather those is critically important.
Mhm. And speaking of enough money, we do have some savings that we do want to offer all of you. So first things first, kind of like for anyone who's interested in claiming shred, Boast is happy to give you free eligibility assessment and also free estimates, followed by a 10% discount if you want to scan that QR code right there. So again, don't leave money on the table. We would love to help you. And Aly, maybe you can share a little bit more about the exclusive offer from the Symend team as well.
There's a QR code there as well, and so we can do an assessment for your business on seeing if the Symend is the right solution to engage with your customers and anybody who has a problem with delinquent accounts, etc. We can do that assessment and see if we're the right fit for each other.
Right, amazing. And with that, I'm gonna pass this on back to Aly.
Thank you both so much for such a thoughtful and just rigorous discussion. I think I personally have learned so much within this overall call, but Aly, thank you so much for expanding on the importance of runway, having a very thoughtful process when it comes to your looking at your capital stack, but most importantly, knowing when to say no at certain points in time as well. Anastasia, thank you so much for being the lovely host and moderator. And we want to say a big thank you to our audience here for joining today, everyone on our call, and most importantly, our lovely partners here at TechCrunch. This has been a great opportunity for all of us today. Most importantly, we'll be ensuring to have our recap sent to each and every individual here, as well as additional point for our offer. But thank you to the entire team, and I hope you got some really great valuable points for today's session, and we'll see you next time.